Hi, guys. Early on Sunday afternoon, just kind of hanging around waiting for the day's NFL action to start. I've been kind of down on the NFL the last few years. I just don't feel like the games have been all that exciting, and the excess of showboating, everything that's gone on in these games just has made it less fun to watch. But we're going to give them another chance. My Ravens, led by the guy who said no to a $250 million contract this week, Lamar Jackson, will be playing the Jets. The local games, I think, are going to show the Dolphins and Patriots. So that could be a fun game to watch. So we'll check it out. Everything's going to have a really hard time living up to yesterday's unbelievable college football game. So that Texas Alabama game, just an absolute classic. And of course, Notre Dame, my Notre Dame Fighting Irish, lost to Marshall University. And all the major schools around the country are now furiously checking their schedule to make sure that they didn't accidentally schedule the Thundering Herd of Marshall for an out of conference game this year. But anyway, jumping right in here, the markets had a nice snapback last week, came up about 3.65% on the S&P 500. A lot of the no profit, all story tech stocks, they caught a bid, and even some of the meme stocks got pushed a little bit higher. I don't think it was real buy-in. I think there was a lot of short covered in there, some short-term trading. We came in with a lot of short positions, particularly in the index. Levered hedge funds have about 4 times as much exposure to the short side of the market as the industry does to the long side. So a lot of those guys probably went ahead and booked profit at the first signs of anything that looked like strength. It's one of those times when selling buying can beget more buying, just as in fast falling markets, selling will always beget more selling, particularly from issues widely held by exchange traded funds. So we probably saw a little bit of that factoring in, and then you had the strong seasonal coming into the Labor Day holiday that probably bought in some cash into the market. I don't think that's going to make a huge difference. I don't think we're going to reverse a new trend. Momentum went kind of neutral by the end of the week. That's on daily. Weekly momentum still quite negative. I don't think that's going to change for an extended period of time, guys. We're going to see inflation numbers this week. Retail gas prices have been falling for artificial reasons, guys. That's got a lot to do with the release of oil from the Strategic Petroleum Reserve. That's starting to slow down, going to go away soon, putting plans in place to buy it back over the next year, which, let's hope that we don't actually need that for something besides price control at any point in the not so distant future. Of course, everything going on in China has reduced demand quite a bit as well, because they continue to run from place to place, putting lockdowns in place to fight COVID. And their real estate market is what we can commonly call a hot mess, and further putting a drag on the economy. All that will heal. This demand will come back. The supply-demand imbalance in oil and natural gas is real. So I expect the prices, they're not going to go straight up. Nothing does. And it's a very geopolitically driven market. So you're going to see some swings up and down, but I think on balance, prices remain at very elevated levels. It's going to continue to be good for the energy companies when you can get them at the right price, get them on down days, and the infrastructure assets that are throwing off a lot of cash. I think they're a solid investment for a very long time. We're going to see the inflation numbers this week. On Tuesday, we'll see consumer price indexes. They're looking for a decline of about 8 down to about 8.1% from 8.4. So yes, guys, it's lower. However, it is lower. It's still 8.1% higher than a year ago. That's still the highest inflation rates since the early 1980s. The core, once we back out food and energy, the core may actually go up a little year over, the rate increase up a little bit. So inflation's not gone. It's not going away. We are seeing some wage inflation. The Atlanta Fed wage tracker rose by 6.7% last month. It's not as much as CPI, so the consumers are struggling to keep up. But it is a lot of extra cash getting into the hands of consumers and helping to keep them relatively financially solid. And that's been the whole thing here. You want to talk about this being in a recession, you go back and you read last week's beige book released by the Fed, and you know what? It's not there. Consumer spending is up. It's still relatively strong. Activity is good. You're still seeing, travel and leisure spending rising quite a bit. Business travel is picking up. So all these segments of the economy are still doing okay. We're seeing some weakness creep into real estate markets. You're seeing higher rates and affordability are hurting the demand for mortgages a little bit. So there's some pockets where it's looking like, okay, it's getting a little weaker out there. We did see a move down in the Conference Board's leading economic indicators index, but the coincident indicators that reflect what's happening right now, they're still rising. So my view of this hasn't really changed. Rates are going to have to go higher. Remember what we talked about here, guys, and we've talked about it a lot. The yield curve is going to have to be positive across the whole yield curve is in terms of real yields. That's yield coupon minus inflation. We're not even close. Fed funds is at about 6%. Everybody's saying we probably need to get it to 4% relatively quickly. That's 4% in coupon terms. And then, net out inflation. Inflation's going to have to be below 4. All of this is going to take time to happen, and it's not going to happen overnight. There's probably not going to be rate decreases next year. It's a good chance we don't see a rate decrease until 2024 unless there's some miraculous decline in the inflation rate that I just don't see happening. I'm completely willing and excited to be wrong about this. Jerome Powell is still saying he thinks he can negotiate a soft landing, maintain the strong labor markets. I've only seen that once in my entire career, guys, and that was in the early 1990s. And the soft landing had absolutely nothing to do with anything the Fed did or anything the federal government did. It had everything to do with the fact that recession, that mild inflationary period, came at a time when the internet and personal computer markets were raising productivity levels at an enormous rate, allowing the economy to continue growing in spite of rising interest rates. So don't think we're going to negotiate that soft landing. But again, I'm more than willing to be wrong about that. Guys, I really think it's time to learn to love the down. Market's still having a hard time adjusting to the idea that rates are going to remain higher. Every time you get slapped in the face with it, like Powell slapped the market in the face in Jackson Hole, markets plunge immediately. And then, somebody will say something that gives a false belief to hang on to that rates will, slow down or the Fed will bring it back down. And this time it was Powell himself who said at a meeting last week that, they're going to fight inflation, but they're really hoping they can do it without the social costs. He serves his purposes better when he admits that there's going to be some pain felt by people and businesses to win this fight against inflation. But with a little snapback rally, I really believe you got to learn to love the down here, guys. I think it could get ugly as the reality of higher rates sets in. All of those great trends that I've talked about over time, they're still there, okay? The acceleration of technology, artificial intelligence, big data, connected cars, eventually maybe driverless cars, definitely driverless cars in the big cities, not sure about on the open road for a very long time. You've got the smart home, you've got smart city, you've got the demand for homes, particularly down in the new home, the first time buyer marketplace. There's millions of cars short of even coming close to meeting that demand. Look, I'm not a big fan of cryptocurrency as the market currently consists. However, the need for digital payments, cross-border payments may create the demand for government-sponsored digital coins at some point. I'm not opposed. I think that is probably going to happen at some point in time. I'm not a fan of regular crypto, but the opportunities are still there for those who believe in it and understand it better than I do. I know a lot of people that have made money trading in what I think are very speculative digital assets, but hey, they made money. So, healthcare is going to continue to change the way we live. It's going to help us live longer, live better lives. So all these trends, they're still going to be there. They're not going away. What is going to happen is we're going to get a chance to invest in them at fire sale prices, at bargain levels. Yeah, there's probably something to that. You can just buy a lot of this stuff here and 20 years from now, you'll be happy. Yeah, that might happen. I don't want to be happy. I want to be really happy. Okay. Um, I want to be able to buy these great companies at great prices. And I think the market's getting ready to give us an opportunity to do exactly that. Now, Charlie Munger of Berkshire Hathaway, who I admire a great deal, he's a grouchy old guy like me that loves to read a lot. The only difference between us is, well, I'm better looking, he's richer, and I like bourbon a lot more than he does. Other than that, we're exactly the same. But he has made the comment that, he and Warren saw the best of times post World War II. Things were happening in the economy, in the markets that probably are not going to replicate themselves. And he said that, if you gave me $200 billion and said, here, go beat the indexes, or 200 million, I think was the number he used, at the Daily Journal meeting back in 2016, I want to say, he freely admits that he would not be up to the challenge. He doesn't think that he could beat the market. And he thinks that if you want to do really well, life-changing returns, you've got to look at kind of niche, illiquid markets. You can't continue to do the same thing that everybody else is doing and expect different results. It's simply not going to work that way going forward. Fortunately, that's pretty much all I do is look for these niche opportunities and invest in them in ways that nobody else seems to be able to stand because they are illiquid. They're not super exciting on a day-to-day basis, but they can and do make you a lot of money. We're working on new ideas all the time to continue to introduce new strategies and new ways to make a whole bunch of money in the financial markets. You have to be different, guys, because this is getting ready. We're coming into a rough period of time in the markets, particularly from current price levels. At the fire sale, the story is probably going to change somewhat. But if you look at the work of folks like James Montier over at GMO, he's one of the brightest guys in the business. Meb Faber at Cambria Funds, Dan Rasmussen at Verdad, and my own work suggests that forward returns from here from traditional stock and bond portfolios, they're really not going to be great. The most bullish is Vanguard, and they're thinking, 3 to 5% compounded. 3 to 5% compounded does not grow your wealth at the pace that you're going to need to do. The other truth is, if you do the same thing that everybody else has done, you're going to get below average results, just like individual investors have achieved literally for hundreds of years. Nothing's really changed. We tend to always make the same mistakes. We're buying when we should be selling and selling when we should be buying. We get too excited about things. One of my favorite stories, and it's a depressing story, so it shouldn't be a favorite, but it's about Peter Lynch when he ran the Magellan Fund from 1977 to 1989. He had a 12-year run, guys. He compounded money at 29% in the Magellan Mutual Fund. He was in all the newspapers. He was constant figure on Barron's. He was at the Barron's Roundtable every year. You could hardly turn around when you're talking about financing without running into Peter Lynch. He even wrote a couple great books on how to achieve the type of results that he was getting. 29% a year. That's incredible. Your money doubles in less than 3 years' time. The average investor in the fund over his run of 12 years was unprofitable because they let headlines, and it's even worse today because you've got the internet, you've got the talking heads of constant cable television instilling fear and greed, and we always end up on the wrong side of that equation. So if we're going to do below average returns when the average is already awful, we need to start thinking about how to be unique, how to be different, how to excel in our portfolios. Done a lot of research on this. We're going to talk a lot more about it. There are ways to do it. I think there's some strategies going forward that are going to earn the type of returns that Peter Lynch did, that Warren Buffett and Charlie did. But bigger institutions and funds, they're not going to be able to play this game, but you and I can. We got to be different. We got to be unique. We got to be quantitative to keep the fear and greed cycle working for us instead of against us. We've got to learn to love the down. Look, buy stocks and invest in assets like you buy steaks. If it's on sale, load the cart up. If it's not on sale, buy what you have to right now and hold off. It's at very inflated prices. Let's try chicken for a while. So these are the things we're going to put to work, trying to blaze a path to the type of profits that, everybody needs to meet their financial goals and make their dreams come true. What is an increasingly complex and complicated financial world. So anyway, guys, that's all I've got this week. No big stock picks or ideas or anything. We'll be back, have some of those later in the week for you. We've got a big week. We got the consumer price index on Tuesday. Producer prices will be out on Wednesday. And consumer sentiment will be out. The University of Michigan figures will be out on Friday. They improved a little bit last time. We'll see what they look like this time. They're still, Jimmy Carter era levels. So consumers are doing okay, but they're not real excited about the future and looking out. They probably shouldn't be, but we'll see what that sentiment number looks like on Friday. In the meantime, I'm going to go kick back, watch a little football. If the games are bad, that's okay. I've started rereading the Sackett series by Louis L'Amour. Have done that in 3 or 4 years, and every so often I like to go back and read it just because there's so many. They're great stories. L'Amour was an incredible writer, but there's a lot of really cool life lessons that you can take away from those books. And I seem to learn something new every time I go through the series. But we said that if you can get a young person, young man in particular, have them read those books early in high school, they'll be a much better adult for the experience. Anyway, that's all I've got for you today. I'll be back a little bit later in the week and we'll share some other ideas. Thanks for watching it, guys.